It's an honor to be here. I really appreciate Christian and Rosa's work and the invitation to speak at this terrific event. I'm going to tell you today about a very interesting opportunity that we found about a year ago in Mexico. We describe as the Mexican Marriott. Before I do that, I just want to give you a quick overview of what we do. We're based in Arlington, Virginia, just across from Washington, D.C. We manage, as Christian kindly mentioned, an international global strategy, mostly mostly foreign equities in emerging and developed markets. We look around the world looking for companies that are trading at a discount to book, very low earnings multiples that are of extremely high quality. We take a long-term investment horizon. And as Christian also kindly mentioned, our firm is minority owned and backed by a group called Markel Corporation. This is a picture, admittedly not a very good one, of the hotel down the street from our office. This is actually the longest continuously operating Marriott hotel in the world. It's really the first Marriott hotel. There was another one, a little motor inn that JW Marriott started that has since been demolished, but it's the real first Marriott hotel in the world. As I said, just a block down the street in Arlington. And what I'm going to tell you about today, the Mexican hotel company that we're going to talk about is, in our view, similar to investing in Marriott in 1959 or in the 1960s when they were getting going. It's a very similar dynamic, and we'll get more into that. So this is the name of the company. It's called Hotel City Express. It trades on the Mexican stock exchange, the Bolsa Mexicana. The market cap is about 9.5 billion pesos, which is about $500 million US dollars or about 400 million euros. It's based in Mexico City, and as you can see, the enterprise value is about 11 billion pesos. The investment thesis is pretty straightforward, although there's been a recent twist that we'll get into. It's a high-quality, rapidly growing branded hotel chain with a dominant position in the Mexican hotel market. What's going on now, and as I said, we'll get more into this, but there's a transaction that's going to occur next month that will really unlock the growth potential of the company and also significantly improve the company's return on invested capital. We hope longer term, frankly, not medium term, but there's a potential sale. We think it's a very attractive candidate to a group like IHG or Marriott or Hilton who needs a exposure to the Mexican market where they're underpenetrated. These guys would make a fantastic platform, but again, we hope that doesn't happen for some time. We hope to be the ones that have the returns and not Marriott in the short term. We think there's an opportunity to earn a high teens or 20% annualized return over the next 3-year period. We focus on that because that sort of aligns with the company's plans, but in fact, it's a much longer term story and a longer term growth runway with very significant value potential. So before the transaction, we'll sort of frame the presentation into 2 parts. This is the before part. The company was founded in 2002 by Luis Barrios and his partner Francisco. They were formerly part of the management team at a company called Grupo Posadas, which is actually the largest hotel group in Mexico. They left there and started Hoteles just down the street. They grew in the 2000s, starting other brands alongside City Express, sort of sub-brands that we'll talk more about. And in 2013, went public on the Mexican Stock Exchange, as I said. Interestingly, the share price is rather similar today to what it was then, not because they haven't created value, but because the valuation is completely different than it was at that point. There was a follow-on offering completed in October of 2014. And then just recently, as I said, in January 2018, the company announced a very significant transaction that, as I said, we'll talk more about. This is a quick overview of the group. There's really 4 components, but as you can see, there's a sort of a PropCo component and an OpCo component. You may wonder why a hotel company is developing hotels, actually building the hotels themselves. And the reason that is because, as you can imagine, in these smaller Mexican towns and cities, going and finding a high-quality property to have a hotel in is exceptionally difficult, if not impossible. So you really need to actually build the hotel yourself to have a proper facility. And There's also a few other benefits. One, they capture the margin, the development margin, and obviously they can control the entry cap rate into the property. So this team has developed over about 22,000 hotel rooms at this point in time. In terms of ownership, they own 54 hotels outright. They co-own, so with other partners, 33 properties, and then there's another 14 that are leased. And it's important to note that going forward, because of the transaction we're going to be talking about, they're going to be focused primarily on owned hotels. The OpCo component, which we find probably the most exciting, is the brand and the marketing. Interestingly, about 82% of the nights booked through the hotel chain are booked on their own platform. And there's a few very good reasons why that's important, but the most important is that they then control the pricing and don't give up a commission to the OTAs. They have a guest loyalty program with about 450,000 members, corporate local agreements, and some really outstanding technology, including the website and analytical tracking. They, in fact, track the amount of water used in each hotel room every day. So that we'll get more into the culture of the business in a minute, but it's really an exceptional platform that they have. And then the brand itself, it's extremely well known. I'll give you a sense for the competitive landscape, but the brand, for instance, when you land at Mexico City International Airport and come out, the first big billboard is Hotel City Express. It's extremely well-known brand in Mexico, and it's really known as sort of a business hotel. About 80% of the nights are business people traveling around the country domestically. So it's a terrific brand. This is the gentleman that built it. As I mentioned, his name is Luis Barrios. He's really a world-class entrepreneur in our view. He went to university in Mexico, then got his MBA from the University of Texas, one of the top programs in the United States. And then, as I mentioned earlier, he started at Grupo Posadas. He started in the company and worked his way up to become CEO. And what happened was Posadas is a family-controlled company. The patriarch unfortunately passed away, and the son came in and pretty quickly got in disagreement with Luis about the strategy of the group. Luis, not surprisingly, if you meet him, he basically went down the road and set up his own firm with the backing of the Boutin family, and he did a small capital raise with them. I believe they invested $7 million at the beginning of 2002. He's grown the company about 30% a year for the last 14 years, and he owns personally about 4% of the stock. We believe that's the vast majority of his net worth. It's a bit hard to capture this gentleman on one slide, but he's completely obsessed with the business. The channel checks that we've done, talking to people that have worked with him and so on and so forth, indicate that he is a workaholic. He, in fact, we did a whole tour of all the hotels, and jokingly in one of the rooms I saw a painting on the wall and said, did the CEO paint that? And the IR gentleman said, how did you know that? And in fact, the CEO has painted all the paintings and they've replicated them. So he's extremely cost conscious. He also built a furniture construction business to outfit all of the rooms, so the desks and chairs and so on and so forth to capture that margin. And all employees, when they're traveling, must stay at the hotels. We understand, stays at least one hotel per week when he's traveling to meet the managers, and is really, as I say, obsessed with the business. A few other traits we appreciate. He seems to be quite contrarian. He bought back stock as soon as it went down around the NAFTA situation, which I'll talk more about. But he was repurchasing shares in the market and was hoping to repurchase a lot more than he did. And there's just an exceptional culture. If you go visit the company, you'll realize that the company really runs itself. He's built a terrific organization. And one sort of side note on this is he really quite seems to understand compensation and alignment of interests. Even the person at the front desk in the hotels gets paid based on return on invested capital instead of occupancy. At most hotels, they have an incentive to simply fill the room at any cost, and in fact, here they get paid only if it makes sense. This is the valuation on an EV to EBITDA basis. You can see that in 2013 and 2014, when the company became public, there was a lot of excitement not only about this company, but also about other real estate companies at that time. And since then, the valuation has come down and really bottomed in 2016 around, as I said, the U.S. elections and the concerns about NAFTA. It's recovered slightly since then, but we believe, as I'll get into, is still severely depressed. The reason for the opportunity, there's a few. One, it's listed in Mexico. As you can imagine, there's not a tremendous amount of institutional interest in Mexican assets, and even less so among the smaller companies in Mexico. NAFTA, I mentioned, and the stock is relatively illiquid. It trades at about 750,000 USD a day. So it trades, but it's not a blue chip by any stance. And the last element, and this is really the key in our view, is that we believe the market has completely failed to recognize the change in business model that's going on, and also the very significant real estate value that's embedded in the company. The real estate on the books is held at 2010 cost, and we believe that in fact the price has really doubled, and we'll see that in the transaction next month. So this is the growth record. They've grown from about 5 hotels in 2003 now to they just opened their 135th hotel. It's about 26% a year compounded, and we believe that in fact this rate could accelerate because they've been capital constrained as they grow, and the transaction that's about to occur should significantly boost this. This is the brand platform that they have. They have 5 different brands. The first, as I mentioned, was the Hotel City Express, the flagship brand. It's still a majority of the rooms and the hotels. Since then, they've added the City Express Plus, which is a bit higher end in better locations in and around cities. The City Express Junior, which is meant more for industrial areas around Mexico, simply the same quality room but smaller. City Express Suite, which is the extended stay, and then the City Centro. They just opened their second one of these. There's one right downtown in Mexico City. It's more catered toward higher end business travelers and tourists, and it's doing exceptionally well. And we're quite excited about this component of the company. The properties are really spread all over the country and give us quite a diversified economic exposure. You can see in the boxes just highlighting some of the areas of activity. They're exposed obviously to agriculture, mining, petrochemicals, and then obviously auto manufacturing and industrial activity. But they're in 29 of 31 Mexican states. I suspect they will be in all 31 Mexican states in short order. But obviously the point here is that if one industry experiences a downturn, you're pretty well diversified on that front. This is really the key, in some sense, to the investment thesis. This shows you the chained versus independent market share in the U.S. versus Mexico. And what's interesting about this is that the U.S. in the 1980s and other similar markets used to look like Mexico. It was still dominated by independent brands, independently run hotels, and now you can see the majority is chains, and in fact that continues. Part of the reason why that continues is the distribution. The OTAs, the Priceline, Expedia, so on and so forth, make it very, very difficult for independent chains to operate, or independent hotels to operate. So our strong belief is that Mexico over the next 10 to 20 years will go a lot more toward the U.S. There's no reason it shouldn't, and the most exciting thing is that we believe that Hotelis City Express is in the perfect position to take advantage of this trend. This gives you an idea of the competitive landscape. At the top is the total hotel market without segmentation. You can see that Hotel City is the second largest hotel chain in Mexico. We don't believe they will be second for long. They're most likely to overtake Posadas quite shortly. Down here in the right is the most important, the limited service. And as you can see, they're at least double or triple, depending on how you want to look at it, their closest competitor, which is One. One is struggling, is growing quite slowly. It's barely a competitor in our view. And so what this shows is that basically there's a barren competitive landscape, that even if other competitors come into the market, that we believe that Hotel City is so far ahead of everyone else in terms of brand and size that it will be very difficult to compete. I should also note that Holiday Inn and Holiday Inn Express, you might say, why are these guys much bigger? The reason is they are there in a smaller size, but have had very poor results. They've had a very difficult time finding local operators to have profitable operations, and so we believe it's also not obviously a focus of Holiday Inn and those brands, so we believe that they've basically ignored the market and allowed Hotel City Express to capture a very significant market share. Limited service, but higher margin. You might think that something like a Ritz-Carlton or Four Seasons would in fact have a higher margin, be more profitable. The reality is Hotel City is in fact the highest margin in the industry, at least in Mexico. The average, as you can see, is 27%. Hotelis, adjusting for the mature properties, is something around 35% EBITDA margin. So we find the business model itself extremely, extremely attractive. So the after. Let's talk about the transaction. This is a quick overview. This was timely today, obviously, because this is happening next month, sometime around mid-April. Effectively, what they're doing is they're splitting the company into two. They are creating a REIT, what is called a FIBRA in Mexico, to drop down the real estate into the mature real estate. And this, it's important to note, is very similar to what Marriott did in the 1990s. I believe it was 1994. They created Host, which is a REIT, and dropped their properties in. So this is a sort of well-known playbook to generate a lot of value and grow quickly. The transaction is expected to be priced at 5.7 billion pesos, so it'll be an IPO to institutional investors. And that's right in line with market. It's not a surprise. That was the market valuation, independent valuation. Hotel City, the parent company, will continue to own 50% or 51%, control the entity. It's a very tax-efficient, stable, income-yielding vehicle. They will initially own 42 of the mature properties, so only the mature ones will be dropped in to begin. And there will be no fees. The other hotel FIBRAs, the REITs in the industry, charge asset management fees. In this case, the only fee be charged would be to manage the hotel like they traditionally do. So there's no asset value being lost there. And they also, importantly, will have the first right of refusal on future mature Hotel City properties. So they will be the ones where the assets will be coming down. The Hotel City will morph into a high-growth management development company with 59 mostly mature, co-owned and operated, maturing properties. Interestingly, they will continue to have a beneficial tax rate as well because they're growing, so there's a depreciation effect there. They also have a land bank and construction in progress worth about 1.6 billion pesos. And then lastly, they have a very long-term, very solid agreement to manage the Hotel City properties. So these entities will remain linked, obviously, for a very long time, but we believe that this is a very, very intelligent thing to do. One of the issues that the company has experienced is that investors haven't been able to break apart the different assets. And this was from the information statement for the upcoming IPO. It was the first time that they really broke the company apart in this way so that you could sort of see the different components. The main takeaway here is the hotel management. Right now, it's about 20% of the EBITDA of the whole group, and you can see the FIBRA and the other components here. We'll on the next slide, slide after this, you'll see what that can become. But this is the new business model, a very simplified business model. Effectively, what they're doing, as I mentioned, is they will build the hotel, so Hotel City, as they do now, will develop the property. It takes typically about 3 years for the hotel to mature. Once it's matured, they will sell it to FSTAY, the REIT, and that cash will go back and be recycled into Hotel City so they can continue to build much, much quicker. So effectively what this is doing is drastically reducing the time, the recycled capital time going through the group. This is the comparison to the FIBRAs. So there's two other FIBRAs in the market, FIBRA Inn and FIBRA Hotel, that at least focus on hotel assets. What's very interesting to us is that these other two FIBRAs, one, are very slow growing, and two, they don't own the brand. They license the brand from JW Marriott or other big players. They simply own the asset. The market is saying that Hotel City's brand is effectively worthless, which doesn't make much sense to us. And in fact, we think it should be valued as a management company, which I'll get to in a second. So this is the company morphing into a management company, an asset-light model. And these are our projections. The first red line is what's about to occur next month. The second red line is our assumptions for a stage 2, which is what aligns with the company's plans in about 3 years' time. And effectively, by that point in time, almost half the group will be of an asset-light model, growing extremely quickly. And at that point, we think that investors will fully recognize the value in the company. As I said, we think it should be valued as a brand owner. It's trading now at about 12 times EBITDA, but most importantly here you can see the growth rates are very far above the industry average. So there's no question that there should be some discount applied because of Mexico, but our view is that it should be roughly in line because it's growing much, much quicker with the peers. So what does that look like in terms of numbers? We've tried to sort of make it simple here. On the left, you have the EV to EBITDA of the management company. You can pick whatever multiple you want to apply, and then the NOI cap rate on the top. And right now the market is about 7%. It's fair to think that at some point it may go to 6% once the uncertainty passes by. What are the risks? One, NAFTA, I mentioned. We believe that the cost of production in Mexico is exceptionally low. In fact, it's below Asian countries in some cases and of very high quality. So we don't believe the NAFTA agreement will be changed, but in the case that it does, we think that they will continue to do quite well. There's a populist candidate leading in the election in the polls that are coming up. It's coming up later this year. A few things. One, he's been moderating his position more toward the business-friendlier side, and secondly, the way the political regime is set up in Mexico, the legislature controls a lot of the power of the president. So even if he wins, we don't believe he will have a lot of power to change. I mentioned the OTAs. They could, in theory, even though it's a small part of the business, put pressure on hotelists. They could raise the commission level and cause some issues there. There's been no sign of that, and they've had a very good relationship, but of course it's a risk. And the last element is the high operating leverage of the business. This, in our view, is being mitigated by this transaction. They're becoming more asset light, lower financing costs, and less bottom line impact. So of course now the environment is fine in Mexico. The occupancies are at good levels, but to the extent you had a 2008 repeat when hotelists did quite well even in that scenario, but to the extent that reoccurred, it could become, it's definitely a risk, obviously. This was the last item, just to give you a sense of where we are. It's quite a difficult environment. As Christian mentioned, we prefer difficult environments, and the bond yields have spiked in 2016, you can see, and the peso significantly depreciated in around the U.S. election. And so we're not currency investors, but obviously the view of the Mexican peso right now is not particularly good. So with that, I very much appreciate your time, and I'm happy to answer any questions if anyone has any.
Thank you. Terrific, Ivan. Does anybody have any question? Any question for Ivan? Nobody? Wow. Oh, yeah.
Hi, thanks very much. How will the development plans be financed? Is it cash from the IPO, or will that be debt financed, so you have a kind of 3-year kind of high leverage?
So this is a good question. Most of it will be, they do have a bit of debt. They're restructuring the debt facility. Some of the debt is going with the FIBRA, some is staying. A minimal amount is staying at the parent. There will be tremendous cash flows coming in, about 2.5 billion pesos into the company. So the management is generally leverage averse, so we would expect that they would use that cash conservatively and also conservatively borrow a bit to optimize the balance sheet. But yes, they're not going to lever up the company, to answer your question.
Thank you very much. So just taking that thought the next stage on then, have you thought about, is there a point in time at which they become self-financing, whereby the management cash flows effectively pay for the growth capex, or is that some way off yet? Yes,
you can get to that point. Certainly, probably after the 3 years, there's a bit of interplay in making assumptions, but yes, it's not unreasonable. The management EBITDA right now is something like 200 million pesos, and depending on how you want to assume, if they're growing in an asset-light way and they can recycle quite quickly, then they should be able to get to that point, and that's exactly the idea.
But if you're growing at whatever it is, 25% per annum or something, how much capital spend do you, and you're building your own hotels, how much capital do you roughly spend to grow at that rate?
Well, it depends, because some of the hotels will be in an asset light, so they don't have to develop them. They'll do it with partners. I could check and sort of get back to you on our modeling assumptions on the exact amount per hotel and that kind of thing 3 years out, but it's sort of a mix across the board. But certainly they should have more than enough capital to grow.
Okay, great. Thank you. Very good idea.
Yeah.
Thanks, Evan. I think you said that 82% of nights are booked on their own platform, so the commission leakage to OTAs is currently quite minimal. Can you maybe talk a bit about their customer acquisition costs
Yeah, so-
versus OTAs, and do you expect that level of direct customer acquisition to decline over time, and would that even necessarily be a bad thing for this company?
Yeah, so the cost advantage, I guess, is one way to look at it versus booking a night on the OTAs is about 20 to 25%. So right there, you're capturing that margin, whereas if you had an independent hotel versus going through an OTA versus the hotel or city being booked on the platform, you would immediately have a lower cost of about 20 to 25%. What they've tried to do is they want to keep the OTAs in there to some extent, because it helps optimize the portfolio. Obviously, there's a very sophisticated strategy of the pricing and on the different platforms. It's a bit of a complex subject, but basically the management believes that having some OTA access or distribution makes a lot of sense. So to answer your question going forward, I would say that more or less this kind of percentage would remain in effect. Does that answer your question?
Yeah, it was also just about, the question was also just about the costs of acquiring customers. The obvious advantage of the OTA is that their customer acquisition costs can be very low, even versus large hotel chains currently in existence.
Yeah,
So I understand their price, they have a pricing advantage versus the OTAs, but in terms of their, what is their strategy and cost of acquiring customers, and is that competitive versus OTAs?
Yeah, the answer is yes. So the OTA is taking roughly 20% of a $35 room night, and theirs, they believe, is, I believe, so that's maybe 6, and theirs is quite a bit less, maybe something like half, including all the marketing and something like that. So that's where the real advantage comes from. But it still makes sense, as I say, to keep some out just to optimize the pricing and so on and so forth.
Okay. Thank you very much.
Thank you.
Thank you.